Asian markets are deep in the red after China reported that consumer prices rose at their fastest pace in 2 years. Inflation in the world's second largest economy accelerated to 2.7% in July. That's relatively low in global standards, but it's the most since July of 2020. It shows that China is dealing with the effects of persistent supply chain bottlenecks and higher oil prices. But it would have been even higher if not for pandemic-related lockdowns that are keeping down consumer spending. Meanwhile, costs for producers rose 4.2% year-on-year. That's lower than the 4.8% projected by most analysts. Share prices in Shanghai fell around 0.7%, and in the financial hub Hong Kong, the main blue chip index was down 2.6%. Now, for more on the story, let's go to Craig Erlam, Senior Market Analyst at OANDA in London. Welcome back to the program, Craig. Now, I just laid out the numbers there. What do these tell you about the state of the Chinese economy and where it's heading?
Well, it tells you that the lockdowns have had an impact, not just on the economy, but also on the inflation data as well. Ultimately, domestic demand still remains relatively weak, and that's keeping the inflation pressures down. That's keeping the demand side of the equation down. So we are seemingly seeing a bit of a peak in the inflation data, although core inflation did rise. The headline inflation figure was slightly lower than expected. Food prices still having a huge impact. The price of pork and vegetables having a big impact on the headline figure as well. But like I said, a core reading still low. And going forward, it looks like we are going to see with lower fuel prices and commodity prices, it looks like we are going to see some of these inflation pressures subside. It's still near the upper end of where the PBOC wants to see inflation. So while I don't think it means we're going to see any kind of tightening from the PBOC going forward, they're going to look to support the economy, but it may actually leave the door open to a little bit more loosening, so lower rates in order to try and support the economy through to the end of the year. The 5.5% growth target now looks out of reach, but they're obviously not going to give up on achieving anything close to that, which has been alluded to overnight, while keeping the unemployment rate lower and keeping inflation under control.
Right, so looking at the other major economy, the US, of course, inflation there also seems to have peaked, and we saw some very good jobs numbers come out of Washington last week. Is the US on a bit of a recovery now after recording 2 quarters of economic contraction?
Well, I think we would all like to see the recovery. Unfortunately, I don't think I necessarily share the optimism. The jobs report was incredibly strong. There's no doubt in that. It's a red hot report. But the problem with regards to the inflation data is that the wage growth was still hot as well. Actually, was a little bit higher than market expectations last week, which has created some of the unease going into this week that we could see potentially a slightly hotter inflation report. What we need to see is a downward trajectory. Ultimately, that's what the markets are looking for. It's expected to fall by around 0.4 percentage point from 9.1%. If we see that or more, then I think that's going to be very welcome by the markets, and that could potentially keep this recovery in the markets going. If we see anything close to 9.1% or more, then I think that could provide a bit of a negative shock. And unfortunately, the inflation data over the course of this year has provided many more negative shocks than it has positive. So I think that's the reason why we're seeing so much trepidation going into this release.
All right, Craig Erlam out of London, thank you for the very excellent breakdown.
Thank you.